Welcome to today's video where we dive into one of the most critical aspects of buying a business, understanding its financial health. Too many buyers rely solely on the profit and loss statements, but these can be misleading. Today, I'll show you why tax returns are the more reliable document and how they can help you avoid costly business mistakes. Whether you're a first-time buyer or a seasoned investor, this information you need to know. Stick around to the end where I'll share how you can get a free business valuation and assessment. Profit and loss statements, or P&Ls, give a snapshot of the business revenue, cost, profits over a period of time. Sounds useful, right? But here's the catch. They can be easily manipulated. Adjustments, reclassifications, and non-GAAP practices can skew the numbers, making the business look more profitable than it actually is. Not to mention accrual versus cash accounting. Inconsistent formats across businesses also make it hard to compare business to business, industry to industry. This is why relying solely on a P&L is risky. Unlike profit and loss statements, tax returns are prepared under strict guidelines and reviewed by tax authorities, like the IRS. This makes them less prone to manipulation. Plus, they follow a standardized format, so you can easily compare one business to another. If you plan on financing your purchase, lenders will look closely at these tax returns more than they'll look at the profit and loss statements. That's largely because they provide the most accurate financial picture. When reviewing tax returns, focus on the key sections: the income statement, deductions, net profit, and balance sheet. Let's break it down. The gross income gives you a reliable measure of the business's revenue. Deductions are important because excessive ones might hide profitability. Net profit is what matters most. It's the final word on how much money the business actually is making. And the balance sheet will tell you about the assets, liabilities, and equity, the complete financial picture. Let's look at a quick example. If you're buying a retail store and the broker hands you a profit and loss statement showing $200,000 profit, but when you check the tax returns, you see that the real net profit is only $120,000. That's a huge difference. The profit and loss statements may have inflated revenue or missed expenses, while the tax return gives the true verified numbers that they actually filed with the IRS. Always trust the tax returns and make sure you have a good description or explanation of why there may be discrepancies. Remember, a lender will put sole decision based on the tax returns. Here's another reason to prioritize tax returns. The banks. When you apply for a loan, banks really don't care as much about the profit and loss statements as they do the tax returns in calculating something called the debt service coverage ratio, or DSCR. This helps make sure that they figure out that the business can repay its debts. Most banks want to see a DSCR of 1.25 or 1.3 or higher. Since tax returns provide the most reliable number, they're crucial in this calculation. To sum it up, don't just ask for the profit and loss statements. Get multiple years of tax returns, and then you'll want to reconcile the two. Why and how do they not match up, or why and how do they match up? Use that to spot trends and confirm the business's profitability. And always work with a CPA or a due diligence financial expert to help you interpret the data and avoid any red flags. Now, if you're considering selling a business, the first step is to find out how much your business is worth. I'll make it as easy as possible for you. I offer a free business valuation and market price assessment with no upfront cost. If I don't sell your business for a price that you're happy with, you pay nothing. There is zero risk. So if you're interested to find out how much your business is worth, click on the link below this video and let's set up a time to discuss. I look forward to working with you. Thanks.